Hey, what's going on, everybody? It is Wednesday, June 1st. Yeah, the numbers are in for May. Let's start off with today's market action. Another down day. We tried to rallied off the lows, kind of like yesterday. Had some deep lows. Came off the bottom, actually opened higher. That rally faded, went down, made some deep lows, came off the bottom. Tried to go positive, but wasn't able to make it. I think the May numbers are pretty instructive, the fiscal flows. Let me go over that. Before I get into that, though, there were some comments today that came out from like Janet Yellen and Jamie Dimon and a couple of Fed members, Bostic, and I would classify those as headline risk. Headline trading. You know, people reacted to those. Yellen said, I was completely wrong on the inflation outlook. How could I do that? I was completely wrong, blah, blah, blah. Jamie Dimon said that the economy is facing a big hurricane or a hurricane. He doesn't know if it's going to be a small storm or a superstorm. Sandy, okay, thanks for that good information. And Bostic was saying, hey, don't try to think that we're going to do a September pause. Don't believe that to be a Fed put. All right, so all these things freak people out. And today is the day when the Fed starts its quantitative tightening. All right, so all those things brought, more fear back into the market and people sold. I don't judge something by one day, but I would say this, and this is a little bit of a cautionary note. Today was the first day of the month. The first day of the month is a big fiscal flow day because you have payments, that's Medicare, Medicaid, military pay, veterans benefits, disability benefits. That's the first day of every month. You get like a 90 or 100 billion flow. So, given the fact that, bank accounts were flush with cash today, government made those transfers, the fact that the market couldn't rally like that, some of that money anyway wasn't put to use, that's a little bit of at least a short-term bearish sign. I would say that would suggest some downside risk. All right, first of the month, you get a big inflow in cash into bank accounts. Some of that money goes into the markets. None of that happened today. It wasn't enough to support the market. And, I would just take that to be a little bit of a short-term negative indicator. Let's go over the numbers for May. All right, May actually ended with 548 billion flow. That was down from what I was expecting. I kept telling you guys we're going to be in the mid 600 billions, but it looks like what happened was that a lot of the May spending was front loaded into the last business day of April. Remember we talked about that, or I mentioned that April 29th was a Friday, and May 1st being a Saturday, all those payments that normally go out on the first of the month, well, they don't go out on a Saturday, so they went out on April 29th, and that, April was a big month. It was like 636 billion or something like that. So that's where the spending went. So May ended with 548 billion. Still, that's, and I'm going to get into that in a minute. 548 billion is nothing to sneeze at, but it's not the 600 billion plus that I was anticipating. However, if you average February, March, April, May, the last 4 months, we're doing 606 billion a month. Now, let me just mention that the deficit for May ended up at 86 billion for the month of May. The federal deficit was 86 billion. That partially reverses. Remember, we had a 323 billion surplus in April. That was a huge liquidity drain in April. That 300 billion tax-related surplus, everybody's bank accounts got drained out. because they had to pay taxes. We got some of that back in April with an $86 billion deficit. But here's the cautionary stuff, I guess. I'll state it that way. Don't forget that May received a $42 billion quarterly interest payment. All right, so that's not going to happen in June, and it's not going to happen in July. It'll happen in August. But so if you take away that $42 billion, then May's monthly spending, or if you look at, if $548 billion was May, and you take away that $42 billion, you're basically looking at what, $500 billion? $500 billion for June, July. Now that's down from, I said, the last 4 months average was $606 billion. Now we drop down to $500 billion maybe in June and July. So that's significant. That's what, not 15-16% reduction in the flow for June and July. Now let me put some perspective on this. Still have a little bit of a hoarse throat. Let's back up. Let me back up and just give you some perspective on this, okay? Prior to the pandemic, see, we're still all caught up, and not just in our minds. And I know a lot of you don't sit around thinking about this stuff. I mean, I do, but let's talk about the economy, just in terms of the economy and how it's operating, or the growth is slow now, like maybe sub 2% growth, maybe 1.8% growth, something like that, all right? The fact is, we've come down, the pandemic period, April, May 2020 until December of 2021, we saw unprecedented levels of fiscal stimulus, all right? Where, we routinely were getting months, 900 billion, 700 billion, 680 billion. I mean, these are fantastic numbers, and they powered economic growth and the markets. That was huge liquidity injection into the markets, and it showed. The market went straight up. All right, now, if we're dropping down to around 500 billion, that's a significant, deceleration. But here's where I want to bring, it's very important to have some perspective in the picture, all right? In the pre-pandemic years, and you can go all the way back to like the fourth quarter of 2009, right after the great financial crash. I mean, we were running at about anywhere from 350 to 400 billion a month. And that period from late 2009 until right up to the pandemic, when it was, the economy was shut down, there was forced closures of the economy. Annual average GDP growth was 2.5% over those years. So from the fourth quarter of 2009, when we came out of the great financial crash, and that was also due to stimulus, all the way up until the forced closure of the economy due to the pandemic, we had annual average GDP growth of 2.5%, and that was occurring with roughly, let's call it 400 billion a month of fiscal flow. Okay? Then we had this huge period, once the economy crashed with the pandemic and we had massive stimulus, okay, then we bounced back. If we take that away, now we're like 500 billion a month. Let's call it 500 billion a month. It's probably going to be slightly higher, but 500 billion a month average monthly fiscal flow. That is still at least 25% higher than pre-pandemic, when the economy, when that period, and we're talking late 2009 up until, April, May of 2020, right, 11 years, that we saw growth of 2.5% annual GDP growth with like 350 to 400 billion per month of fiscal flow. Now we're coming down to a lower level. We're coming down from, let's say, 680, 750 billion down to 500 billion, but that's still 25% higher. Those fiscal flows are still 25% higher than the period I talked about from late 2009 until April, May 2020, when the economy averaged 2.5% annual GDP growth. So what does this mean for everything? Because that's obviously the question you want me to answer. I think we're on a positive growth trend, but it's a slow growth, a slow GDP growth trend. Okay, inflation also, I have to say, reduces it. Like you might say, well, why, doesn't that mean we should grow at 2.5%? No, we're going to grow under 2.5% because why? Inflation. We're running big trade deficits, so that's a subtraction, right? That flows out. That income flows out to the foreign sector. That's a subtraction. So we're going to be running under 2% growth. Is that great? Well, it's not fantastic. It's less than what we've seen on average over the last 11 years. But is it a recession? No, it's not a recession. Does it mean the stock market's going to shoot straight up like what we became used to? No, it doesn't mean that. Does it mean the stock market is going to crash like what we saw from January this year up until recently because of the rapid deceleration in economic growth? No, it doesn't mean the stock market's going to crash. What it means is it's going to be a challenging market where you're going to have some sectors that are going to do very well, like energy. And also, I wonder how the effect of the growth slowdown is eventually going to impact oil and petroleum. Look, I've been saying this. I'm not getting bearish on oil until I see producers go net short oil futures. They've been net long oil futures. Producers have been net long oil futures since November 2021. And I mean, until I see them flip that around, I wouldn't even think about going short. So energy stocks should be the bulwark, that they should be doing the heavy lifting in your portfolio. And I think it is prudent to buy the market on dips. I think tech stocks, particularly that are so beaten down, big names, I think it's prudent to buy those on dips. And I think it's also reasonable to assume we're going to have a slowly rising uptrend. Look, you got to also acknowledge the fact that sentiment is still really, really bearish. I mean, really, really bearish. Okay, so I mean, you got a lot of things coming together that are creating a bullish picture for the market, but not a bullish picture where, it's going to go straight up. We've become jaded over the last 2 years thinking like that's what happens. And I think, by the same token, a lot of people think like when it goes up like that, it's got to crash the same way, but that's not necessarily true. Okay? I mean, if we drop down to, let's say, if the federal government were running now monthly surpluses, like month after month after month, a net drain, then yeah, straight down. Because that would be the opposite of the fiscal stimulus. Instead of 600 billion a month or 500 billion a month, how about if they were running 300 billion surpluses every month? Straight down, straight down. I wouldn't even know where the bottom would be. Maybe at zero. I have no idea. But that's not the situation. Okay? And the situation is not that dire. It's more challenging now. You got to have some patience. You got to step in when the market's down. We're going to have growth. It's just not going to be 6.5%, 7.5%, 9% GDP growth. It's going to be like 1.5%, 1.8% GDP growth. It's slow. So everything slows down. The trajectory of the market slows down. Corporate profits, all this stuff. So that's the update. That's the best I can do. Again, it's all in the flows. It's not, I should say, and I did say, I have been saying that I do believe quantitative tightening, which of course is not a tightening for the umpteenth millionth time I'm saying this, it will factor in to rising bank credit loans. And that is a supportive factor as the fiscal, kind of scales back a little bit. So that's it for today, folks. See you tomorrow. Bye.